Hello, and thank you for joining Hamilton Lane's Private Wealth webinar. I'm Jackie Rantanen, Managing Director, Evergreen Portfolio Management, and I'm thrilled to be joined by Mario Giannini, our Executive Co-Chairman. With over 30 years of experience navigating private markets, Mario's insights are second to none. In this Q&A, we'll tackle some of the hottest topics shaping today's investment decisions. So Mario, jumping right in, I want to acknowledge that people might have a bit of tariff fatigue, so we won't spend a lot of time, but I do want to specifically ask, how do you think tariffs are impacting investment decisions, such as portfolio allocations? And what are the implications for private markets investments?
Yeah, I think the answer is very different today from, remember in April for Liberation Day, it seemed like tariffs were going to be the dominant conversation topic for every investor, and it was going to change the entire landscape. I look at it today, and here's what I would say on a macro level. You're right to have tariff fatigue. I mean, we're all tired of talking about it. And you should listen to what I have to say about it, but here's where we should listen. What are the markets saying about it? And I'll look at three markets: the equity markets, the debt markets, and the currency markets. The equity markets globally, not just in the US, are saying it's okay. Like, tariffs are not going to be a huge deal. They've recovered basically to where they were before all of the tariff announcements. And I would listen to the equity markets on this one. They are telling you that, earnings may be hit here and there may be some macro issues, but it's not going to be something that drives investment performance. They may be wrong, but I'd rather be listening to the markets than to Mario giving his view that tariffs may or may not be a big deal. I think the debt and currency markets are saying slightly different. I think they're probably a little more worried, but not enough to say that you should change your investment outlook just because of tariffs. The other thing I'll add, just from a private equity perspective, because we're talking about private markets and private equity, when you look at the type of companies that are in most private portfolios, they are not impacted by tariffs the way these big, giant public companies are. And so even if you took the April timeframe when people were really worried, in the private world, tariffs were just not going to be an enormous driver of investment performance up or down.
Do you think with that perspective that there are certain sectors that you would maybe think about as the most resilient, even if there's not a major impact, as you're saying? Would you still maybe focus on certain sectors?
Sure. I think that if you look at, and we've done a real analysis of where tariffs might or might not impact companies. And what you see is that there are, I would characterize it as two broad places where you probably want to be invested. One is the technology sector. It tends not to be as impacted by tariffs. And I'm not talking about semiconductors. I'm talking about technology, software, things like that tariffs really don't impact. And that is a place, obviously the private markets have been very, very active. The other place is nearshoring, whatever it's termed, where you are investing in companies that are very much focused on domestic industries, whether it's domestic industries in the US, whether it's domestic industries in the EU, where you're not worried about these enormous supply chain issues that might or might not develop, or you're not worried about these tariff issues that might impact either your costs or your ability to generate revenue. So I would say those two areas remain places where, even if you say tariffs overall are not going to have this enormous impact, at a micro level, they certainly can. And you want to minimize the impact of those as you think about your investments.
Okay, that's helpful. Let's pivot away from tariffs, but talk about other areas of uncertainty. New deal activity, for example, and realization activity remain light. So what are the implications for private markets? And specifically, because we're talking to a private wealth audience, for evergreen funds more specifically?
Sure. Look, the question I get asked more than any other, at least as much as any question I get asked, is, when the hell am I getting my money back? Like, what is happening to distributions? Deals are not getting sold. Where is this big, remember at the beginning of the year, we were all told that it was going to be an M&A boom, that right, particularly in the United States under the new administration, the animal spirits were going to be unleashed. And it hasn't happened. And count me as a skeptic in terms of it happening to any huge degree. I think that activity will remain slow, particularly relative to what it has been in the past. But let's put some of this in perspective. When you look at distributions, so money going back to investors, last year, this year will probably be one of the highest absolute level of money returning to investors in history. Now, relative to the size of the private markets, it's down, and I think will remain somewhat down. But that is not to say that there's no M&A, that there's no money coming back. I think this is going to be a challenging period for private markets. And frankly, that's what you want, because that's when the better companies, the better investors, the better managers will have an opportunity to shine. You will see who really was just going out with the tide and who really knows what they're doing in terms of that. So yes, it is down, and I am continuing to say that it will remain down relative to what we saw 3-4 years ago, but it's not zero. People have this sort of view of the switch is binary, it's all or nothing, and that's just not the case. So for evergreen portfolios specifically, I think if you're building a good portfolio with good companies, you're going to see distributions, you're going to see good deals. I don't think that it's an environment where you're saying, oh, there's nothing happening, therefore the private markets are dead. That is completely mischaracterizing what's going on in the markets.
And you've maybe alluded to this a little bit in your last comments there, but you've been doing this for over 30 years, investing in different markets and different cycles. How do you think about market cycles, volatility, and investing?
Yeah, so yes, I've been doing it for a long time. I'm old. You can see I'm old. I don't recommend getting old to anyone, but if you do get old, hopefully you benefit from the experience you've had. And we have been through these cycles. Here is what I will say as probably the most important thing around how you think about this. Look at a long-term chart of equity returns. And what you see is a fairly solid line that goes up. It's interrupted by some real cycles that go down. And if you lose track of where you are in the markets and say, oh my God, we're going down and we're not going to go back up, you lose the entire benefit. And so my view on cycles is they happen. But the amazing benefit of private markets is you are forced to tell yourself, I'm not going to look at a 6-month cycle. I'm not even going to look at a 1-year cycle. I'm looking out 3 to 5 years. And that's what I need to be doing. I can't focus on whether today is the exact right time to do A, B, or C. I'm focused on whether it's the right thing to do over a 5-year time frame, a 7-year time frame, pick whatever time frame you have on that. And that to me is what I've learned. I have learned, I don't put it in practice, but I have learned to stop listening to my emotions around, oh my gosh, look what's happening. I got to do something. No, you don't got to do something other than take that step back. And I had a CIO tell me once, whenever I really feel like I have to do something right away, I go take a nap. When I wake up, I realize I really didn't have to do something right away. It's decent advice for investors.
That is good advice. Let's shift to another topic that we're hearing a lot about. I'm certainly hearing a lot from advisors, and that is secondaries. And there's a lot to unpack here. There's been a recent influx of evergreen funds into the market. Many of them have a focus or a partial focus on secondaries. And so maybe from a big picture perspective, what does this mean for the market? Is there too much capital focused on secondaries?
The short answer to that is no. I don't think there's enough capital focused on secondaries. I mean, there may be over a period of a month. I'm not at all arguing that there are certain short timeframes, but secondaries is really an interesting part of the market because it was sort of this niche, unknown part of the market for years. And if you look at secondary returns, they have done very well compared to virtually any other part of the private markets and those returns. So this isn't something that was just invented last year in order to accommodate evergreens. This is a part of the market that institutional investors have been using for 25 years and using really well, and it has worked. And I think what people need to unpack around secondaries is that they are an investment choice, the same as primaries, the same as credit, the same as infrastructure. They are a way to position a portfolio and generate a return. Now, one of the things that people all talk about is, well, I know what's happening with secondaries. I buy them at a discount, and the discount is all the return, and the assets are junk. Sure, that can happen, but the reality of that market is, and again, we're going back 25 years. If that was the case, all of that stuff, people would be going, well, I'm buying junk, I don't want it. That's not what's happening. You get a discount, but the real appreciation, the real value in buying those secondaries is those assets increasing in value. The virtue of secondaries, and this is important, is you can identify those assets you are buying today. You can make a judgment of what they're worth, and you can make a judgment of when you think they're going to be sold. And that, to me, is a enormously powerful portfolio tool that people can use, and again, have been using for a very long period of time. It just seems to me that what has happened with secondaries is they become associated as a gimmick or tool that you only use in evergreens. That is a total, again, mischaracterization of what is going on with a legitimate group of assets that belong in everybody's portfolio.
I think that's really helpful backdrop. What would you say, though, to investors about the headlines that they're reading when you see big institutional investors like Harvard and Yale selling portions of their portfolio? How should they interpret that?
Yeah, I get a lot of comments that, hey, Yale is one of the founders, essentially, of using private markets in portfolios. If they're selling, then that strategy must not be any good anymore. And if they're getting out, am I the one left holding the bag? Two things. First is that is not an accurate characterization of what is going on in that market. Endowments associated with universities want to raise cash. They are facing some pressures from the United States government. And if you think about how they look at their own finances, what is the most important thing for many of those institutions, Harvard or Yale, is to have liquidity. And we can debate the merits of private markets, but they have illiquidity. So if you're one of those institutions and your priority is creating liquidity, sure, you're going to sell some of your private markets. They are not going to zero. They are creating liquidity. The other thing, and this is back to the initial question about secondaries and their importance in portfolios, it used to be 25 years ago when this first started with secondaries that you were selling because you were distressed. You needed to sell for whatever reason. They are now a legitimate portfolio tool to help you manage a portfolio. I don't think that's what Yale is doing. I think, as I said, they're doing it for liquidity reasons. But concurrently, there was recently a very large U.S. pension fund that sold a big chunk of private equity assets. And they specifically said they were doing it because they wanted to streamline their portfolio. They wanted to free up money to put into their core set of managers. It's what you do on the public equity side. It's the exact same thing. You just couldn't do that 15 years ago in the kind of very normal, structured way you can today. So my own view is that you will continue to see secondary sales by organizations, institutions doing it for reasons that have nothing to do with their underlying view of private markets, other than they want to remain in private markets. They just want to change the way they're running their portfolios in private markets.
Really, really helpful. Let's shift gears and talk a little bit about geography. So you travel a lot. You hear a lot of different perspectives. In the past 2 months, you've been in Miami and Tel Aviv, Toronto, Milan, and Rome. So using that perspective and the experience that you have, how do you think investors should think about geographic diversification in today's investment decisions?
It's a little trickier than it was. I think, and I'm not saying anything that hasn't been talked about in the press quite a bit. We have just gone through an era of what's been called American exceptionalism. And that's not a philosophical question. It's a question of, the U.S. has been drawing in an enormous amount of investments because people have perceived the United States as the better place to invest compared to other geographic locations. If, again, looking back at the markets I was talking about earlier, if you look at the currency markets, the dollar being weak in the face of higher U.S. rates, currency markets are saying, I don't know that American exceptionalism is warranted today for probably political reasons. But I think we'd have to take another step back and go, okay, in the private markets, in equity, probably 70% of the market is U.S. based. In credit, it's probably more. In real estate, it's less. Infrastructure is global. So if you think about all of those markets in that way, and let's focus on equity and credit for a minute, I still believe that the dominant part of your portfolios probably should be in the U.S. in the shorter term. I'll talk shorter term, 3 to 5 years. I don't see anything that is happening today that says the U.S. economy is going to be weaker relative to the EU economies or most of the Asian economies that I would say, oh, you've got to move all your investments somewhere else. And the size and liquidity of those markets makes a big difference. So I think today, geographically, you're probably not making any fundamental shifts in how you think about where you invest in your private markets portfolios. The question is open longer term because obviously if a lot of people decide that they want to invest outside the US, then that will drive opportunity, that will drive liquidity. But I think that is too early today to make that kind of judgment.
What about currency? I mean, that's certainly something that we haven't talked about a lot in the past couple of years, but are you thinking about that in your investment decisions as a discrete factor?
Yes, I think you have to now. If, again, I mean, you look at what the dollar has done in the past 6-9 months, it's gone down. If you were a non-U.S. investor investing in U.S. fixed income, you had a loss when you account for currency. And so as a non-U.S. investor, you have to think about hedging. And for us, as you know, when we invest for investors outside the U.S., in the evergreen space, we have hedge classes. So you make sure that you're doing something with the currency issue. Obviously, for a U.S. investor, it's probably not a huge deal. I mean, we've always joked about U.S. investors don't even know there's a currency other than the U.S. dollar. And I think that will probably be the case for some time. But even when you're now looking at underlying portfolio companies, you have to think about where is the currency that underlying portfolio company is generating revenues from, and how do you think about that currency in terms of translating it back into investment performance?
And so you've referenced this, but the U.S. has been the largest private equity and private credit market for some time. And so it's overweight in many portfolios. So does today's macroclimate impact that view more specifically?
It impacts it, as I said, in the sense that you have to think about it now in a way you probably didn't 3 or 4 years ago. I mean, 3 or 4 years ago, it was so easy to say, oh my gosh, you look at the U.S. growth, you look at the U.S. all this, that, and the other, and you didn't have to worry about tariffs. You didn't have to worry about any costs that might be imposed on capital. So I do think it is now a topic of conversation. It is now a topic in investment committees where you go, okay, what if? You're doing scenarios around that. But as I said, when you look at where the growth is, when you look at where the capital probably will continue to flow, I think the U.S. will remain, particularly in the private markets, in equity and credit, the dominant location for capital.
Well, Mario, you have been very generous with your time. So I'll just ask you one last question. And that is, many of our investors are newer to the asset class. And so as we sit here today, what would your main piece of advice be for those investors?
It sounds simple. It's impossible, almost impossible to carry out. I think the question I've been asked more than any other for 30-something years is now the right time to invest in private markets? And that question is always asked for a couple of fundamental reasons. It's because you're all market timing. You're asking that question because you think you already know the answer. It's a rhetorical question, because what you're asking me is, I don't think it is because the markets are too high. I don't think it is because markets are too low. I don't think it is because the markets are too volatile. And what I will tell you is, people that have done really well in private markets, investing generally, but certainly in private markets, have always asked that question and then basically said, you know what, the answer doesn't matter. Today is the right time. Because the real question you got to be asking is, how much of my portfolio should be in private markets, and which one of the private markets do I want to be in? And I will invest programmatically over whatever period of time you decide. And don't pay that much attention, because I will guarantee you that no matter what you think the environment is today and what your prediction is for 3 to 5 years out, you will be wrong. You'll be wrong. You just will. I'm sorry. I've been wrong. I believe I can market time. Empirical evidence suggests I have no ability to do that. And so don't make that bet. Just put the money in and believe that your overall strategy will get you to where you want to be. And it will.
Thank you, Mario.
Thanks.